Good morning, everyone. Welcome to this update for global stocks and commodities for the 8th of March. And there's been plenty happening. Another very, very volatile period, particularly the last couple of days of the week just gone. But look, the important thing here is that you get your mind off all the negatives, the red all over your screen, and you focus on the positives, of which there are some, and you focus on the opportunities because that's where the real money and progress gets made. When you focus on opportunities in this kind of market where panic is just prevailing all over the place. So overall, obviously you'd have to be somewhat wary at the moment in the short term because we just can't predict what emotions and markets might do. But you've really got to try and look beyond that and look at the possibilities. So yes, I'm wary, I'm cautious, but I'm still very excited by the possibilities because there are technologies and advancements out there that are just going to continue, and it's got nothing to do with the virus or even global economic growth, whether it's weak or otherwise. These things are just going to go on. So that's the things that you've got to focus on. So for me, this is really a time to start to get your contrarian antenna out. Be cautious, but it's not a time to run and hide. And I've had a few emails from people that questioning whether they should just get out of the stock market, and unequivocally, my answer to that would be no. But obviously, it's how you manage it. So the real battle here is not with the market; it's what's going on between your ears. It's really a psychological battle. Is the main thing. Portfolio analyst last week, I just obviously covered what was what was happening with the fallout from the virus epidemic, and just some general perspectives on investing as well, which I think are really important at this time. So again, just some comments, just an overall perspective, just to try and get everyone's mind on the right track here. The last couple of weeks have just seen emotion and speculation about how bad things might get, and that's just completely taken over. It's throughout the media, and it's affecting absolutely everything. We're seeing it not only in the stock market, we're seeing it in everyday life with all these pictures of people stockpiling toilet paper and the like. This is just herd behaviour at its absolute extreme. The bottom line is, who knows what is going to happen over the next few weeks or few months. But I can tell you that succumbing to emotion is absolutely no way to invest. It just isn't. So focus on controlling what you can control. There are obviously how the virus spreads and what impact that has on the stock market in the short term is not something within our control. So let's not worry about that. Let's just control what we can control. My only concern is not that the virus is going to, drag the global economy into a recession, because that's never happened before. But it's the fear rhetoric and the actions of governments in closing down borders and closing down economies in the attempt to contain the virus. That has the possibility to do a lot more damage than the virus. So that's probably my larger concern at the moment. But on the other side of the coin, and we're seeing some of this in China already. China's starting to get back to work, and the China stock market has been pretty much unaffected through all this. It is also possible that this is just a correction of an overbought market. Now, there'll be a few viewers out there who'll jump up and down and call me an idiot like they did last week, which is pretty disrespectful. But, that is a possibility that this could all blow over fairly quickly. I'm not saying it will, but it's possible. So, why just focus on what all the negatives could be? So just a couple of bits of reality, and they're all over the place. The China market is pretty much been unaffected through the last month. US earnings forecasts have not slipped yet. Now, that may still be a process yet to unfold, because analysts just haven't sort of got around to quantifying the impact. But there are still quite a few positives out there. The ultimate bottom in the market is impossible to pick, so we shouldn't even try and focus on that. What we should focus on is just monitoring what's happening out there to try and get some sort of sense of the duration of the impact of this virus and the impact on the stock market as it unfolds. Get your mind focused on more positive things. There will be, and there is, a massive central bank stimulus, and that money has got to go somewhere. So let's look at the practicality of how markets work. That money has to go somewhere, and I think I'll get to this point in a later slide. Just the comparative attractiveness of the stock market compared to other investment avenues. So it's boring but true, but quality stocks rebound from disruption. It happens every time, and it'll continue to keep happening. So, let's not worry too much about where the quality stocks may go in the short term. Because the bottom line is, if you don't need that parcel of money and the price right now to spend, and if the price goes down and then goes back up again 6 months later, then what does it matter? It really doesn't matter at all. So just focus on what you can do, and things that you can do, and I've spoke about this last week, is you can have more cash. Now, that should have been done a few weeks ago, as I advised, but this is a time to have a bit more liquidity. This is a time for more cautious entries. Don't be too quick to want to jump into the market thinking that on the first day up you're going to miss out, because this volatility is going to be with us for a little while. Now, GDPs around the world are going to take a hit. There's no question about that. But markets are looking forward, and the best opportunities are going to come when the news is at its absolute worst. So remember that. When things do really look grim, that's when your contrarian antenna need to be well and truly up. Let's look at American stocks. Amazingly, I had to shake my head when I got to the end of the week, because it just seemed like it was just so negative all week. But the S&P actually rose 18 points, or 0.6% across the week. It was just, a very poor finish to the week, and a lot of volatility in between. It's safe to say that low interest rates, if not zero interest rates, are now with us for a very, very long period of time. That raises the model that analysts use. So the analysts plug in a risk-free rate, or a government bond rate, into their valuation models. And if interest rates are zero, then technically, from a model point of view, that means that valuations go to infinity. Now, clearly that's crazy, and you're not going to value a stock at infinity, but it just illustrates the fact that with rates at this sort of level, that valuations are, traditional valuations are just completely out the window. And that's why people that are using this Cape-Shiller index and pointing at how overvalued the US market is compared to the 10-year averages, it's just crazy, because we're in a completely different environment. So you want to forget about all those things and just understand that stocks, a fair valuation for a stock in this kind of interest rate environment is going to be far higher than it was before. So the traditional models of valuation or comparative yardsticks just don't apply anymore. So what we need to do here is we've just got to get past the fear of the virus. Now, I don't know how long that's going to take. Could be weeks, could be months. We just don't know. But, we know that it's not going to collapse the sky, and life is going to get back to normal. I think the Fed cutting interest rates by 50 basis points on Wednesday has perhaps done more harm to the psychology of the market than it did good. Now, we know what they're trying to do. They're trying to make a symbolic step that they're going to do whatever is necessary to provide stimulus for the market. But I think a lot of people are starting to understand that interest rate cuts are not going to do it. If demand is not there, then people aren't going to spend more because of interest rate cuts. And therefore people are sort of looking at that and thinking, well, is what is the Fed seeing that we're not seeing? So I think that symbolism from the Fed perhaps backfired a bit on them, and we saw the markets down, quite sharply after they did announce that rate cut. US dollar continues to drop quite sharply. That was because of the interest rate cut. So no one I don't think, saw 50 basis points coming. So now the US dollar has dropped from being 99.5, it's now down to the low 97s. And incredibly, the 10-year yield fell sharply. I spoke last week about this, that it was down to a historic low of 1.13. Well, now it's down to 0.74. So, money just pouring into bonds, which is obviously now at another lowest level ever. But look, the bond market is absolutely a fool's game. I mean, why would you lend money to the government for 0.74% for 10 years with with all the things that could happen in the next 10-year period? So clearly people are not investing in bonds for the dividend, for the return. That's just crazy. They're doing it because they're looking for capital gain. They're looking to front run the Fed, knowing that the Fed will be probably lowering rates further. But when you step back and really look at that, that is an incredibly dangerous game. It's a far more dangerous game than in the stock market. And a bond which is yielding less than 1% has an earnings PE ratio of greater than 100. So people look at stocks trading on PEs of 50 and say that's silly. But at the end of the day, they're buying into bonds with an earnings yield of well in excess of 100 times. So it's not remotely sensible. So it's no wonder that stocks are still attractive when you've got this so we've got a lot of liquidity coming into the system. We've got bond rates as low as they are. Cash obviously is nowhere to be either. So stocks are still attractive. And when we get past this fear about the virus and how far and quickly it's going to spread and what impact that's going to have, then stocks are still attractive. So don't lose sight of that fact. Let's have a look at the chart. So we'll start here with the S&P on a monthly chart, which I think is really instructive at this point in time, because if we look back at the various periods since 2009, so we had 1 or 2 months disruption in 2010. We had a couple of months disruption in 2011. We had another bit of a disruption from August 2015 through to January of 2016. We then had another 2 months of disruption at the start of 2018. And then, of course, the last quarter of 2018 when central banks were tightening. We then had another 1 month down in May of last year. I can't even remember what that was about now. And now look where we are now. Yet the market has gone from 800 points to 3,000 points. So these periods come along. And when you're in the middle of them, they seem scary. And everybody who wants to be a headline grabber jumps out of the woodwork and tells you that this is the top in the market and we're heading into a bear market every time they do it. And every time they've been wrong. And at the moment, I don't see a basis for them to be right this time. I just don't. It's just guessing. Now, one day they'll get it right, but that could be in 5 or 10 years' time. So investing is not about trying to anticipate the start of the next bear market. You can't invest like that. So, just as I've been saying repeatedly, just play it, play the ball as it comes down the pitch, just according to what's unfolding in front of you. Let's zero in a little bit and have a look at the washing machine of the last couple of weeks in particular. And yes, it's done some technical damage. We've broken the 200-day moving average. We've got extreme volatility. But one thing I'll point out is that if you look at for the Friday before last, there was an extreme turnaround in the last hour of the market. If you look at an intraday chart, and that was there was and I believe this to be a fact. There was an order came in for S&P mini futures for $25 billion. And that raised the question about whether that was the US government's plunge protection team putting a big floor under the market. And then again, we saw on Friday night just gone, if you look at the intraday chart, there was the market was down here, was right down the bottom of this candle with about an hour and a quarter to go. And then in the last hour, the market turned around. And I would like to bet that there was another big order in the futures market putting a floor under the stock market. You know, the US government in an election year is going to do everything they can to stop this market falling apart. You can bet your life on that. So pretty volatile. And, if we have a look at the VIX index, so the VIX, these are closing prices. So last Friday, the VIX spiked to 49. And then in the last hour came back to 40. And then again on the Friday just gone, the VIX spiked to 51, but turned around and came back down and finished at 42. So these are incredible levels. And there's only been one time when the VIX has been above 50, and that was in the GFC, where it spiked to 80 for a week or so. So these are completely unsustainable levels. The VIX index will come back down again, and stocks will stabilise and do whatever they're going to do. But this is not a time to be panicking, that's for sure. If we look at the China market, so this is the Shanghai Composite Index. It's trading at the same level that it was at in February of 2016. And it's trading at the same level that it was at in February of 2019. This is a weekly chart. Now it's trading at the same level as December 2019, before this whole coronavirus thing exploded. So the China market is not reacting to in the same way that Western markets are. Okay, I just want to point out through all this, and again, get your mind focused on productive things, not destructive things. There are stocks both in America and in Australia. There's not that many of them, but they are there, that have actually been highly resilient during this selling. And these aren't recommendations by any stretch of the imagination. These are just plucked from workbooks where I've got hundreds and hundreds of charts. So this is Atlassian, which is actually an Australian company listed in America. Look at its share price action over the last 3 or 6 weeks, say. It's virtually not moved. So that's one example. Let's look at ICE, Intercontinental Exchange, one of the world's great businesses. There was a bit of a disruption here, but that was nothing to do with the virus. That was to do with a suggestion that they were going to pay $30 billion to buy eBay. So put that aside and look at the price resilience over the last few weeks. Let's look at a mini Alibaba in China, Pinduoduo. It's virtually not moved over the last few weeks. Let's look at Alibaba itself. Pan right back and get a bigger picture perspective of Alibaba. Now, we've come down from 230 to 205, but that's not much of a move in a stock of that size. So there are really highly resilient stocks out there. So if you've got some cash, I'm not saying that you would buy these or that you would buy them now, but if you've got some cash, if these stocks can't fall very much during what's just been thrown at the market in the last 2 weeks, then they're not going to. So they're the sort of stocks that you need to focus on for when this market stabilises. So focus on the positives. Let's turn to Aussie stocks. The Aussie dollar edged higher. That was really about the US dollar going down. And the next main supports on the Aussie, that's 60 and 50, as I covered last week. Now our market fell another 3.5%. We were down 9.5 the week before, so we're down 13% all up. The challenge here, as I said at the start, is your psychology. It's not the market per se. It really isn't. Quality growth stocks are going to outperform because they're going to follow all the unstoppable trends that are out there in technology. I won't list them all. Everyone knows what they are. And all the social change, the way that we, the way that we pay for things now, and all the demographic themes that are out there, they're all unstoppable themes, and they're going to continue way beyond the impacts of this virus. So quality growth stocks that are tapped into those themes are going to do very, very well in the future. So think about those. And many of them have little, if any, impact from the virus or the global economic growth rates. Nearly all the stocks in one of my services, the Insiders Club, nearly all of those stocks are pretty much immune, or not immune, but they have very, very little direct impact, if any direct impact, with the virus or global economic activity at all. So there's lots of places and opportunities. So these falls, particularly in the Australian market, have been very much about emotion and profit taking, and it's scary, but that's what it's been about at the end of the day. It's not been about the underlying businesses. Okay, let's take a quick look at the currencies. So the US dollar. So you can see we've probably, I think it's safe to say now that we've now fallen out of this channel, this uptrending channel, and we are now probably in a sideways band. Now, whether ultimately that band breaks down or not remains to be seen. But certainly the US dollar has come off the last 2 weeks. Now, if we look at the Australian dollar, it's gone up as a consequence of that. Turning now to the Australian market, this is the ASX 200. Had a very bad finish. I just got a sneaking feeling, given the reversal again in the US in the last hour on Friday night, we might actually see a bit of a relief rally in the Australian market. But look, the big problems in our market is the energy sector. So Woodside, Santos are just getting absolutely smashed. That's down quite dramatically from over 12,000 points down to 9,000 points. So that's a 25% decline. The banks are down about 18 or 19%. They've been absolutely smashed. Healthcare has certainly been the place to be in Australia. CSL, Cochlear, ResMed, stocks of that nature have held up really well. BHP and Rio, so this is the materials sector. BHP and Rio have come off, but not as much as the energy or the finance sector. All right, let's take a look at the gold market. So this is gold on a daily chart. So you can see we've had some dramatic volatility between 1560 and almost 1700. So about $140 range over the last 2 weeks. Let's look at it on a weekly chart, and you can see we're still very clearly in that very powerful uptrending channel. So gold finished the week at 1675. So very, very strong uptrend. But let's look at GDX. Normally GDX and other gold stocks would amplify the move in gold, but look, it's effectively done nothing, and we had a massive down week the week before. So really, GDX has gone nowhere since August of last year. Now, other gold stocks, so GDX represents the big gold stocks, and there's a reason why they're down, because or they're underperforming, because they've been very poorly managed businesses for much of the last decade. And there are other gold stocks that have gone up quite nicely. But in a normal market, you would expect GDX to be leading the underlying metals quite comfortably, and it's not happening. So this is a very strange market. So gold up $90 to 1675, and it's just been incredible volatility. Now we are entering a seasonally weaker period until we get into May, June, but the fear about the virus and the volatility in the bond market is just overwhelming the seasonal weakness. It's overwhelming the massive overhang in the futures market. It's overwhelming all those things. Now, the gold stock market is not really going with it, but certainly gold is. And it's apparent now that where a lot of the money coming into the gold market is going into now is going into ETFs that cover gold, not ETFs that cover gold stocks, but that cover the underlying metals. So people want to use the convenience of gold ETFs rather than, physically owning gold. So precious metal stocks definitely underperforming at a big picture level. They would normally be amplifying the percentage moves in gold by about 3 times, and that just isn't happening. So this is a very strange market. All right, commodities, copper, slightly higher. That was really, we had downward pressure from the market, but we had upward pressure from the currency, and that ended up with copper going up just a few cents. Crude oil is down another 10% because of the failure of OPEC and Russia talks on production cuts. And so energy stocks just continue to get hammered. So it's definitely not a place you want to be at the moment. There's the spot copper chart. So up very slightly. Nickel also up slightly. Again, really currency impact. So to wrap it up, you've got to find a way to avoid getting emotionally engaged in this market because it's just going to do you a huge disservice. It's been 2 pretty tough weeks, but just think about history. We've had several viral epidemics. We've had 9/11, we've had the GFC, we've had the tech wreck in 2001. And all of those, if you look at the long-term chart of the stock market, all of those are just blips on the long-term chart. So, don't overreact to where we are at the moment. And if you look at the comparative attractiveness of money, so we know that there is massive liquidity coming into the global financial system. We've got 10-year US bonds now yielding 0.74%. We've got the S&P dividend yield at 2.1%. So that's what stocks are actually physically paying out in cash flow. And then we've got the S&P earnings yield of 6.5%. So take your pick. Where would you put your money? Now, I know that money is going into the bond market because they're fearful about stocks falling and they're trying to just protect their capital. But they're putting their capital into the bond market at an incredibly extended and dangerous time. When things go back to normal, the bond market is going to come back savagely. It's going to come back savagely much more than the stock market is likely to fall. So where are you going to put your money? And a lot of people are going to start to realise this over time. So the stock market is going to gain support. There's no question about that. Using a fact-based approach rather than an emotional approach has won the day handsomely for all throughout this last decade. The people that have freaked out at every little event that came along in the last 10 years are far worse off. So why change now? Just stay with a fact-based approach to your investing. What happens if you decide to sell now? So, the pressure's building up, you've psychology stretched, and you decide you're going to sell out. Well, at best, you may avoid some further downside. I don't know whether there will be or there won't, and I'm not really spending too much time thinking about it because it's unknowable. So why waste your time on it? So you may avoid some further downside. However, will you then have the courage to buy back in at prices that are lower than the exit you took? And the overwhelming answer to that is probably not. And so therefore, if you get out now, when you do get back in again, which you're going to have to do, then you're probably going to be getting back in at a higher price. So will you simply be responding to emotion and just running with the herd? You know, if you own quality stocks, such action makes about as much sense as stockpiling toilet paper. If you needed to cash up, you needed to do it early, which is what I advised my members to do on day one when this started. So, you know, that's when it needed to be done. So look, this is just a recap of the actions to take, and this is basically from last week. I said raise some cash for attack purposes. Well, it's probably too late for that now. But look, if you've really been caught out and you're fully invested and you need to raise some cash, then use the rallies to advantage. There will be some rallies along the way, even if the market does go lower. So try and get out on positive days, not negative days. And follow the approach that I discuss every week. Have a big, robust watch list of quality stocks that are plugged into the unstoppable themes for the future. Have the patience to wait for the dips and the reversals. Be considered, be cautious, but when you decide to pull the trigger, be decisive, because the windows of opportunity are not all that large. Focus on the best individual stocks, not the index. You know, go looking for the stocks that have been holding up really well during this last 2 to 3 weeks. And then don't automatically buy them, but go and do some research on them. Now, portfolio analysts coming up this week, again, it's just, more of the same, getting prepared for the opportunities. Now, the 10-bagger portfolio has taken a pounding in the last 2 weeks, but my view of that is, so what? You got to look where those businesses are going to. And over the next 2 to 5 years, that's the 10-bagger project. It's a 2 to 5 year project that I've committed to. You just got to look at where those businesses are going. So that's it for this week. There's my contact details for anyone who's not a member. Managing through this period is just so much about your psychology. It's not about trying to analyse the market. So I hope these thoughts today are helpful for everyone. Be back with you next week. Cheers.